Hey everyone. Before we get into today's show, I want to give a quick shout out to our sponsors, Coinbase Prime and Ledger. Love these companies, genuinely proud to call them sponsors of the show. You're going to be hearing all about them later from me, but now on with the program.
Let's say Bitcoin gets big enough, it becomes worth, tens of trillions of dollars. That things that people have put an additional monetary premium in for lack of good money might get drawn out and into Bitcoin.
Bitcoin has really come through on its value proposition, which is a store of value.
All right, everyone. Welcome back to On the Margin. I'm really excited for this week's show. We got a couple of all-stars in the form of Lyn Alden and Mr. Jurrien Timmer. Welcome, Lyn and Jurrien.
Thanks for having me.
Nice to be here. Nice to see you, Lyn.
You too.
I actually want to start with one of Lyn's charts here. If I can pull this up. And ultimately, I'm really interested in this idea of comparing different periods in history. And Lyn, two different periods that I know you talk a lot about, and Jurrien, I know you have opinions on as well, is just this idea of comparing the 1940s and the 1970s as different time periods. So I guess, why did you think to put together these two charts that we're looking at here, which is kind of a history of, for those of you not watching on video, century of U.S. debt as a percentage of GDP and a century of U.S. monetary and fiscal policy? What does that tell you about those two specific historical analogs?
So I've generally found that the idea of the long-term debt cycle is, the kind of the closest thing I have to like a master framework for what's going on right now. And it's one of those things where obviously every cycle is going to be different. It goes back to that quote that is, I don't know if it's correctly or incorrectly attributed to Mark Twain, but it's like, history doesn't repeat, but it does rhyme, right? So when, we went into this period and people keep talking about these, extraordinary events happening, unprecedented, never seen these types of things before. And just by happenstance, I had been researching this topic for years and just kind of, it's one of those things you never know exactly why you come across the right sources. But I came across this type of research. And so this actually, in my view, prepared me for what we went through over the past 2 years because we did have an historical analog for it. We did have some bottlenecks. And so basically what this shows is that, we go through the normal business cycle. And most people just think in terms of those 5 to 10 year increments. But what we see through history is that, for reasons related to demographics and politics and, distributions of power between capital and labor and all sorts of reasons, we go through these long-term debt cycles as well. And so basically this chart shows, 100 years of history in terms of fiscal policy and monetary policy in the United States. And so we can break it apart into, the chart on the left there shows private debt as a percentage of GDP. It's technically a little bit of state debt in there too, but essentially it's all the debt sources of entities that cannot print their own money. And then you have federal debt in blue. And we see the history of kind of debt accumulation over time. And then on the right-hand chart, you have short-term interest rates, you have monetary base as a percentage of GDP, and you have fiscal deficits in gray lines as a percentage of GDP. And, it doesn't tell you everything, and there are differences between the 1940s and the 2020s, obviously, right? So there's technology differences, there's demographic differences. Back then we were a creditor nation. Now we're a debtor. Now we're like a debtor nation, structural trade deficit nation. But there's a lot of similarities. And so basically what they did last time was they had so much debt in the system, they had so much fiscal spending, and so when they did that massive fiscal spending and it was inflationary, they were still pretty much forced to hold interest rates low anyway. And so that was kind of different from the 70s. And basically it's just the way that I'm kind of thinking about this environment and then using that as a framework so that, this is kind of my baseline. And then I look to see what is different. So what are the differences from that period? What is happening in this time? What are the specifics? And go from there. But I really find that this helps contextualize where we're at.
Yeah, I would agree. I do notice that you've called out a couple of banking crises here. Is that just a coincidence, or is that a strain on how would you put the causal arrow there? Is it you think some of these strains stress the banking system, or are they causal and actually creating some of the problems?
Well, as we see, those were peaks in the private debt to GDP cycle, and so you generally had speculation and all sorts of things leading up to those, different specifics. But you essentially had, speculation and debt accumulation and basically malinvestment leading up to those, but because a debt bubble popped, and because it was so big, instead of a normal credit cycle, you had unusual measures taken, right? So you had currency devaluations and other things like that to address those. And so on one hand, you had some nominal defaults, but you also kind of changed the denominator, currency itself, right? So in the 30s, you eventually devalued the dollar relative to gold, and in the 2000s and 2010s, we did quantitative easing. We recapitalized banks. We did the trouble asset relief program. So both of those were ways to try to salvage the banking system and start, reducing that debt, partially through defaults, but also just partially through, diluting the currency.
Yeah, and if I just add to the excellent points that you just made, Lyn, the financial crisis was obviously a bursting of a private debt bubble, right? Banks, corporates, households. There was not really a government debt issue at the time, but then the debt, through QE and the TARP and everything got essentially redistributed to the government, and it didn't happen exactly like that in the 30s and 40s, but in the early 30s, you had the private debt bubble, and then in the 40s, you had this massive run up in government debt, during World War II, and there are definitely parallels there. And now we're in this financial repression age, just like we were in the 1940s, where governments can't afford high interest rates because there's too much debt out there.
If I'm looking at these two periods of time, the primary factor that sticks out for me is you had periods of secular inflation, both in the 1940s and the 1970s, for different reasons. The primary difference there was interest rates and how the government or the central bank controlled them to try to mitigate the crisis. So back in the 1940s, it was unpalatable to raise interest rates. You essentially had yield curve control, and there was an era of financial repression. And in the 1970s, debt levels were relatively low, and you obviously had Volcker, who aggressively combated that inflation by famously hiking interest rates and successfully, I guess, fighting that inflation. Is that an accurate summary, or am I missing some of the nuance there?
So I would say that basically there were different bottlenecks. And so the 2020s and 1940s were a federal debt problem, as Jurrien mentioned. And so those were the inflations of those eras were in large part from the fiscal stimulus that was necessary for external reasons. Basically, those external reasons kind of forced these big almost like MMT-like programs. The 1970s had a different set of constraints because, as the chart shows, at that point we had already inflated a lot of the debt away. We had pretty low debt. We also had a strong era of growth for a while, and so both public and private debt were low, and so they were able to raise rates. In that era, the bottlenecks were a couple. One is obviously we went off the gold standard, and I've had other articles where I've shown charts, for example, that if you looked at foreign ownership of treasuries, because those are the ones foreign ownership of dollars and treasuries, which by extension are dollars, were the ones that were still redeemable for gold. And so we started to have this period throughout the 50s and 60s where our gold reserves were drawing down, but our external liabilities were increasing. And eventually we had a crossover point. And the French and other creditors started to notice this, so they started wanting the gold. And so basically we essentially had too many dollars to keep backing them by gold at that rate, and so we had a breakdown of our monetary system. And then two, if you look at domestic U.S. oil production, it peaked in 1970, and it then went structurally down for decades. We basically just ran out of the ability to keep expanding conventional oil at that pace. So we're obviously still producing it, but we were producing it less, even though our demand was still growing. And so we had to shift towards more imports. And that, of course, when you're also going off the gold standard, we had a variety, basically an inflationary environment for those monetary reasons combined with those physical restraints connected to energy and other things. And so I would describe the 70s as a lot more specific compared to the closer analogy with the 2020s and the 1940s. But there are elements from the 70s as well. I mean, we have similar fiscal programs, and I think we're arguably going to have some energy shortages.
And I would just add, I think the real comparable is actually more like the mid 1960s, right? If we look at stocks to bond correlation, this inflation creep. If you look at a 5-year CAGR of the CPI, we had the 50s and 60s, very, very low, stable inflation, low, stable interest rates. And then during the mid 60s, that started to kind of trend higher. And of course, we all know what happened in the 70s. But the second half of the 60s, you look at the 1968 stock market peak, that was all about speculation in essentially meme stocks. They were space stocks at the time. And you have, like the social unrest we had last year. That happened obviously in 1968. So there are some parallels with the 60s. And I think for us as traditional investors, and I'm speaking on behalf of Fidelity here, what that does to the 60-40 paradigm is really one of the most existential questions out there. Because if the 40 stops working, we need to find other things to put in that bucket. And as you can see, there are other things to put there, but that could be a sea change after 20 years of dominance of the 60-40 model.
I agree. One thing I'll add, so what I do find the 60s particularly useful for is that it's a closer comparison in equity market terms than the 40s were. Yeah. Because the 40s, we went into that decade with very low equity valuations. We obviously had the whole, the Great Depression. Then even in the initial phase of the war, up until the, some of the early decisive victories in the Pacific, equities were very pessimistic. So they went into that period with low valuations, and so that's not necessarily a good framework for determining equity performance in this environment, because you had very different starting valuations. Whereas the 70s or the late 60s, you had the Nifty 50 stocks, and so you had these large cap U.S. growth companies that could do no wrong, and that were very highly valued, combined with the fact that we were running into a more inflationary environment from a very disinflationary low rate environment. And so you end up getting a decade of poor returns, even though many of those companies, those companies were like Disney, Coca-Cola, Xerox. They did incredible for decades fundamentally, but they were just mispriced in the late 60s. And so I actually do think that the 60s and 70s are, of course, still very illustrative to us, and especially in terms of say, the equity market.
By the way, I'll give you a quick trivia. By the early 1970s, at that peak in January 73, the Nifty 50 stocks had twice the valuation of the next 450 stocks in the S&P 500. Exactly the same thing that happened in 2000. The different cast of characters, but it had double the PE of the rest of the market.
When you look back at history, there's a tendency that that we as humans just do. We like to reason by analogy, and we like to pattern match. And why I wanted to, Jurrien, I love this slide that you put together, because depending on who you talk to, there's a lot of different historical examples people tend to cite, right? So, if you're looking at, the late 1960s or early 1970s, I love that example of the Nifty 50. I was actually just listening to Bill Fleckenstein and Grant Williams make that exact same comparison between the Nifty 50 and the FANG stocks, although we lost the F in the FANG, so now I guess it's the MANG stocks. Doesn't sound as nice, but it's kind of funny though. So, and we've obviously got oil that looks like it's making, a run, as it famously did back in the era of the oil embargo back then. So it seems like there are some examples there. But obviously there are some correlations, I guess, back to activities that was happening in, the 1940s with just sustained negative real rates, and that, we could be returning to that type of future. So I thought those were both really helpful examples. I guess if I put the question to you, is it a more helpful analog to look at the period of the 60s to 80s as an environment that we're heading into, or the 1940s, to early 1950s, which is more helpful? Do you have an answer there? Is that too simplistic a question, and really it's more nuanced than that? How would you frame looking at these two periods of history?
Yeah, I would just say, and I agree with Lyn in quoting Mark Twain, is that there's going to be snippets of different analogs that are going to be relevant in some ways, but totally irrelevant in others. So obviously the 1940s, that was, World War II. The demographics were totally different. We didn't have that deflationary tendency from technological advancement. And in many ways, the 70s are totally different. The rate, the percentage of the labor force that was unionized back then was about 25%. It's 6% now. So, obviously we have a different kind of wage inflation of basically a lack of truck drivers and other things that maybe will be resolved without the help of unions. But so there's always going to be similarities and differences. But one of the things that really struck me early during COVID, a year and a half ago, was people were looking at the 1930s, say, oh, this is like 1929. And then, we had that double-barreled fiscal monetary response, and Lyn has mentioned that many times as well. And to me, that really was the game changer for this cycle that made this cycle less like 1929 and more like the 1940s. I mean, there are only very rare instances where you have this double-barreled fiscal monetary, right? So you got fiscal deficit spending, a big fiscal impulse essentially monetized by the Fed. And of course, the Fed didn't even exist before 1913. So the Second World War is really the best and almost only example of this kind of twin policy response. And that's why I very quickly went to the 1940s analog, with the caveat that many things are different, including the valuations, as Lyn mentioned. The PE ratios were very low. The equity risk premium was in the double digits. It was hard to imagine, seeing that it's about 3% right now. But what I find interesting is that if you look on the left-hand side of that slide there, so this is kind of an unusual way of showing market history, because I show it as a scatter plot of the nominal 60-40 against the real 60-40, and you're able to kind of see those periods of stagnation or inflation in the stock market, or at least in the 60-40 model. But if you go all the way on the left, that's the 1940s. And what's interesting is that there was really no other place to be than in stocks, because the bond market was completely repressed. The Fed increased its balance sheet tenfold from 1942 to 1946. There were price controls because of the war. So the commodity indices really don't show what probably was really going on. And so other than equities, everything else would have been a major drag on the portfolio. Then you go to from 65 to 80, which is in the middle of the chart there, and you can see that there were a lot of places to go, mostly in commodities, gold, silver, commodities in general. And we've constructed a hypothetical tips series going back to 1926, and using that, with all the caveats involved, hypothetical tips series. Tips would have done very well during the 70s as well, but obviously we know bonds and cash did not. So, I think it's our job to kind of see where the similarities are, but also to see how they're different. And, history is never going to repeat itself. But I think that fiscal monetary double-barreled response is really what sets this cycle apart, and I think explains why that left tail a year and a half ago was cut short to such a dramatic degree.
Yeah, I basically say that overall, I find that that kind of long-term debt cycle, the 40s, is kind of, I think, for me, kind of the biggest kind of framework for thinking about it. And then what I do is I go to these other periods and I find those similarities. So the 60s, like we said, as the equity comparison and the energy comparison. Another analog you can use that, for example, Luke Groban uses is Europe in the 20s, 30s, and 40s, because back then the United States was in some ways like the emerging market. We were the rising power, and so we were the creditor nation. We were the exporter, and some of those had their industrial bases damaged from the war. The UK had trade deficits. And so he uses some of the more European analogs for determining where we are in the cycle. And I think there's a lot of validity to that. And so I basically kind of go through these kind of, one by one, and kind of, put a patchwork together to come up with the closest thing. Another thing is, in terms of say hypothetically how tips would do, or how short-term treasuries would do in general, a big difference between the 40s and the 70s is if you parked your money in those shorter term treasuries, you could retain at least somewhat more of your purchasing power than you could in the 40s, because in the 70s those short term rates would eventually adjust to kind of keep up with inflation as the Fed tried to fight it, whereas in the 40s, because they completely gave up from the start on fighting that inflation, and instead capped the yield curve, those short term ones actually did even worse than the long term ones. And so really kind of there's nuances like that are helpful to know when navigating this.
Yeah, the compound annual growth rate for long-term government bonds from 1942, which was the start of the war, of at least the U.S. entering the war, and 1951, which is when the Fed gained its independence, the CAGR for that period was 2.4%. and the volatility, the annualized vol was about 2.5%, even though the CPI was up 5.6% during that time, and probably a lot more because price controls kept that down. So, we had a period for, I think, 3 decades where the forward 20-year return for long-term government bonds, the real return, was negative. So that was a very difficult value proposition to owning any bonds. Fortunately, things have changed since then.
I think it's very interesting that your kind of baseline in this last slide, Jurrien, you chose the 60-40 portfolio. Another narrative that you hear talked about a lot is kind of the death of the 60-40 portfolio. There was a chart that was getting passed around on Twitter a little bit. We covered it on our roundup last week. Although I guess it'll be 2 weeks ago by the time this comes out. And you're looking at kind of sentiment. Bank of America does their famous survey of global fund managers, and sentiment for bonds is the lowest that it's been in 20 years. Jurrien, I read your note. Before this interview, I know you kind of share in some of that negative sentiment as well. One thing I actually, this was completely new to me. I thought this was a really interesting chart that we're looking at here, and kind of this idea that of the inverse correlation between inflation having an impact on that inverse correlation between stocks and bonds. So maybe can you describe a little bit more about like what we're looking at here and what that has to do? What are the implications for kind of the future of 60-40 as a portfolio structure?
Yes, as I mentioned earlier, it's an existential question for many investors in the traditional markets, because the 60-40 paradigm has been extremely successful for the past 2 decades, right? If you look at a long-term kind of CAGR against the volatility, 60-40 has returned 9% nominal, so that's against inflation of 3%. That's 6% real against an annualized volatility of about 9. So you've given up 2 points versus an equity-only portfolio, which the S&P is up 11% over that time, but you get peace of mind, right? So you can sleep better at night, because we know historically that the market does always come back, but sometimes it comes back slowly, and you can only appreciate that it comes back if you don't sell when it's down. And having that 40 in there with that negative correlation to the 60, I think helps investors sleep at night and not panicking. But that 60-40 paradigm has only really been around for the past couple of decades. It was also around during the second half of the 50s and early 60s. But what I show in this chart here is the 10-year inflation rate, so the CAGR for the CPI on the horizontal, and the 5-year rolling correlation of the S&P 500 and long-term government bonds. And what you see is that kind of that spike down to the bottom. That's the disinflation era. So, the average inflation rate over the past 100 years or so is 3%. And when you are kind of in that 1 to 3% zone and very stable, like we have been over the past couple of decades, the correlations have been very negative, and that is the whole value prop for 60-40, right? In the old days, you could own the 40 to earn income, both nominal and real, and if you got some insurance out of it against the 60, then that was a double win. But in recent years, of course, there is no really. I mean, there's a very small nominal return. We know. Mathematically, that if you hold bonds to maturity, your return is going to be the yield that you're getting right now. So for long-term bonds, that's about 2%. And if inflation stays north of 2% in the coming years, which is not a prediction, but it seems fairly plausible, then you're kind of locking in a negative real return. So that means that right now, the only reason anyone would buy bonds and hold them to term is for the negative correlation against the S&P. But what this chart shows is that when you have periods of rising inflation above the long-term average of 3%, so that would be the upper right-hand quadrant of the chart, the correlation will flip to positive. And that's exactly what happened during the 60s. During the 30s and 40s, the correlation was positive. So like I said earlier, during the 40s, there was literally no reason to own any bonds because you got a 2% nominal yield, you got a negative real yield because inflation was running at 6%, and bonds were positively correlated to stocks. So you didn't even get the insurance benefit of protecting yourself during equity shocks. Then that flipped negative during the 50s. It had its negative extreme of about minus 40% or so correlation in 1960, similar to where we were in 2015. And then in 65, it flipped positive, and then it stayed positive until around the late 1990s. So for multiple decades. So again, in an ideal world, you're in a 60-40 portfolio, and you're getting paid for the insurance because you're getting a yield on that 40 and you're getting that negative correlation. But the yield is now gone. The forward returns are very likely to be negative in real terms. And so we have to just rely on that negative correlation to keep that value prop alive. But if that flips over to positive, and again, that's not a prediction, but if it were, then that leaves you with basically no reason to own long-term treasuries. Now, that you can own other bonds, high yield, tips, floaters, you name it, but I'm speaking purely about long-term government bonds here.
Yeah, I'm bearish in real terms on bonds in general globally, especially sovereign debt and longer term bonds. A caveat is, again, going back to the the 70s, shorter term bonds could protect you more than longer term bonds because as yields went up, you could roll your shorter term bonds into newer issues with higher yields. And you still didn't do great, but you did okay. Whereas in the 40s, the ironic thing was that even though you had inflation, longer term bonds did better because the whole yield curve was capped. And so basically, if you were holding a 10-year, you were getting like 2.5% yield. And you just kind of holding that for the decade pretty much. It wasn't going any higher, and you were getting inflated away, but you were still earning 2.5%. Whereas if you were holding T-bills, you were getting paid less than 0.5%, and still getting that inflation. And so actually you had a weird thing. If you look at the central bank balance sheet, because in order to do yield curve control, they had to buy a lot of bonds. They basically had to have an open bid in order to buy bonds to defend their peg. And what you saw is in the early phase, they bought a lot of long duration. But then as this went on and the market saw that the Fed's yield curve control was credible, they started to say, well, wait, I mean, if we have an artificial positive yield curve just pegged here, then I'd rather just hold the long-term stuff and at least get a small yield. And so the Fed actually had to twist this entire balance sheet because nobody wanted the T-bills. Everyone wanted the longer term stuff. And so the Fed had to change their structure, basically do an operation twist, but in reverse, to accommodate that shifting demand. And the Fed, they wrote a paper back in, I believe it was 2019. It was published in early 2020, right before this whole pandemic thing happened. And they went back and reviewed that whole situation, and they talked about the challenges of doing yield curve control in the way that they did. And so there are nuances for what duration you want to own in this sort of environment, but the general structure is that I'm bearish on bonds. I like tips, better than normal bonds. Kind of like the least bad thing in the pile is a way of looking at it. But yeah, one of my overall theses is to find things to replace bonds with, because I do think that most portfolios are structured with the idea of the past 20, 30, 40 years of structural disinflation from a high inflation level, which is very good for the 60-40 portfolio, and that inverse correlation. And so everyone's kind of positioned to fight the last battle. And so I think that's not a great portfolio going forward. And so yeah, I structurally agree that I generally want things other than bonds, with the caveat being that if you can have some cash or T-bills or bonds for dry powder, if for whatever reason you have a view that equity markets are going to perform poorly over a specific time frame, and you can kind of rebalance into that. But that overall, the more you hold in those bonds and cash longer term, you're locking in a nearly guaranteed, flat to negative return, real return.
Jurrien, you have a great slide here, basically on the utility of holding Bitcoin as a hedge for bonds. And a lot of the folks that I follow and really respect in this space have kind of drawn this consistent analogy as well. If you refer back to that slide where you kind of highlighted different inflation regimes, so you looked at the late 20s to early 50s as financial oppression, late 60s to early 80s as inflation heating up, and we might potentially be entering another regime of secular inflation. And Bitcoin is clearly an outperformer. So I guess help me understand, what is the relationship, I guess, between Bitcoin as a hedge for bonds, and then I guess just your thoughts overall on the asset.
Yeah, no, I'm glad you asked because I was just going to weigh in after Lyn spoke about bonds and what you can own instead of long duration government bonds. And it's very interesting because this chart's a little bit busy, but it's a hypothetical portfolio of the Bloomberg Barclays Intermediate Government Corporate Bond Index. So maybe a proxy for what a corporate treasurer might have on the balance sheet as an index. And then I swapped 2% of that index into Bitcoin. And to me, it shows that in recent weeks, or in recent weeks, which is only a small snapshot in time, Bitcoin has really come through on its value proposition, which is a store of value. And so, for instance, if you look in 2018 on that chart, so the top panel shows the additional year over year return of a 98-2 portfolio versus a 100% intermediate government corporate bond portfolio. And in 2018, of course, we all know what happened to Bitcoin. So then the excess return went negative. The additional volatility of owning just that 2% in Bitcoin went up another 4 points or so. And the drawdown of the portfolio against its 12-month high was actually amplified by owning Bitcoin. So that was, 3 years ago, literally the opposite of what a diversifier should be, right? I mean, if it adds volatility and amplifies your drawdown, that's not what you want as a diversifier. Fast forward to, just the last few weeks, what we're seeing is that the additional vol is only about 1.7 percentage points, which is, I think, reasonable for owning a very highly volatile asset class, of course. But look at the drawdown. It's actually been cut in half by owning just 2% of Bitcoin. So the value prop of store value, protecting purchasing power during periods of financial repression and or inflation, but they often obviously go hand in hand, is bearing fruit right now, again, with the caveat that this is just a small window in time. But it really is, Bitcoin is coming through beautifully as I think what many people see it as. And my approach when I kind of did my deep dive on Bitcoin about a year ago, my conclusion was, in a 60-40 portfolio, where does Bitcoin belong? And my sense is I don't want to touch the 60. Like the compounding ability for equities over the long term is so undisputed. I mean, you can have drawdowns and it can take a while to recover from those, but whether you go back 50 years or 100 years or 200 years or 300 years, the compounding magic of equities is unparalleled. And so I don't want to mess with that. But, as we're talking now, if we're in an era where that 40 is impaired, at least in real terms, maybe not in nominal terms, but certainly in real terms, we need to find substitutes for that 40. Maybe not entirely, but we need to find other asset classes. And to me, that's where Bitcoin goes. Maybe a decade ago, we would have put gold in that spot, and maybe we should still put gold in there. I've got gold in there as well, and also silver. But there's no question that Bitcoin is that shiny new version of gold that also has a lot of network convexity.
I agree with that, and I can add, I think, a couple of points that I've discussed a couple times, which is So if we were to go back in history before Bitcoin existed, gold would be the go-to for this. It's kind of an alternative currency. It's got, if you look at history, it's got anywhere between a 1 to 2% annual growth rate in terms of estimated supply growth per year. It's extremely stable. It's very, very hard to produce more gold quickly, even when the gold price spikes. And so you have this very stable kind of hard money currency. And, there's not a lot of demand for that in an environment of stable monetary policy where you have positive real yields, because there's an opportunity cost for holding this zero yielding asset. But when you're in an environment of inflation, and then specifically inflation that's higher than the interest rates, then suddenly, a zero yielding asset looks a lot better than a negative yielding asset that they're printing a lot more of. And so that's why, for example, if you look at the 80s, inflation was still high, but gold did poorly because by that point, yields were above inflation. And so there was a case, Volcker had addressed the negative yield concern. And so, after gold had that bubble, a lot of capital wanted to get back into treasuries because you actually had a positive real return now. And so gold has been a great, protection against, the devaluation of currency and bonds. But of course, now with the invention of Bitcoin, we have this other asset that we can explore and that is, taken arguably market share and also just thought share and basically mind share from gold. And so we have this, again, we have a scarce, money that doesn't, we know it's supply issuance. We know that it has this hard cap. It's for the most part globally accessible. And this is, this kind of sovereign debt problem is mostly a global phenomenon, at least among developed countries. But of course, you also see inflationary events even more thoroughly in emerging markets for mostly separate reasons. And so there's naturally a demand for this, especially in an environment where we're going to have probably persistently negative real yields for quite some time. And the caveat of say you look over the past 12 years or say 10 years of Bitcoin's price history, and it's not necessarily like this one-to-one and say inflation hedge because it's, for most of that time, it's this very small, volatile, kind of crazy asset. And so it's kind of like how if you look at, say, a growth stock in the early days, it tends to not be super correlated with anything in some cases because it's kind of on its own cycle. It doesn't really care about recessions, for example, because it's growing at like 40% a year and it's eating its competitors. And so it's going to grow regardless of what the economy is doing. But of course, once it gets big enough and it becomes the sector, then it becomes more susceptible to those cycles. And so Bitcoin in the first decade or so is this emerging asset class from zero. And so it doesn't fulfill its inflation hedge or store of, it's like an emergent store of value is how I describe it. It's this asset that the market is kind of testing and getting to know, and it's exploring its total addressable market cap, and it's kind of coming into its own as a store of value, inflation hedge type asset. So a lot of those kind of historical comparisons for it, or as much as you can call 1 decade historical, are not going to show this precise defense against inflation or financial chaos like we saw in March 2020 when Bitcoin fell along with everything else. But I think the whole thesis is if you understand it and if you come to understanding you think it's going to be successful, then I think in the long run, looking over the 2020s, it is likely to do very well compared to, negative real yielding bonds. Kind of like how, most hard assets should do pretty good in that environment. But then if you look at Bitcoin's qualities and for whatever reason you come to the conclusion that it's probably going to take market share from other things and become a bigger share than it currently is of global assets, then it would probably be one of the better ones, if not the best.
And you have the whole network effect, right? I mean, that obviously was part of that parabolic growth. And, I've done some work comparing it just to Apple stock. I mean, obviously apples and oranges, no pun intended. But, you have the growth, the exponential growth of the network, and then the valuation grows exponentially to the exponential growth of that network. So you have this Metcalfe's law, of course, but that to me describes, the first 10 years of Bitcoin. And I think now that it's coming of age and matures, it will have really multiple use cases, the network being one of them, but the store of value being another one.
Howdy, everyone. This episode is brought to you by Coinbase Prime, the leading prime brokerage solution for all things digital assets, providing secure custody, trading, and financing to an institutional suite of clients. On the retail side of things, I am more than happy to make this endorsement because I have been a customer of Coinbase since the day that I got into crypto. I still keep the vast majority of my assets there, actually, and I do it for one reason and one reason alone, so that I can sleep easy at night knowing that my funds are safe. It's the same reason when family or friends ask me, where should I buy my first Bitcoin? I direct them to Coinbase. And now, finally, when institutions are starting to ask, what's the most safe infrastructure to use? I only point them in one direction, to Coinbase Prime. And the reason that I do that is because it is peace of mind. When it comes to security, everything is top of the line on this platform, and it's a white glove experience to boot. They've been securing client assets at scale for 8 years, which as of Q2 of this year is $180 billion. They have an industry-leading insurance policy, and they're audited by blue chip auditors so that you can sleep easy at night too. So, stop listening to me, click the link at the bottom of this episode, and go check them out for yourself. And when you get there, tell them that I sent you because I love to get credit. When it comes to crypto, security and custody is paramount. Introducing this episode's sponsor, Ledger, your secure gateway to buy, exchange, and grow your crypto assets. I know I've got a smart audience, so I'm assuming/hoping that most of you already have your Ledger hardware wallet, but just in case you don't, this is how I think about it. I wouldn't get into a car if I couldn't wear a seatbelt, and I don't operate in crypto unless I can do it from my Ledger hardware wallet. Crypto is really exciting, but it is still the Wild West. There are lots of risks, and Ledger is the easiest way to make sure that you are still protected. And the best part about Ledger is that you don't need to make any trade-offs between security of your funds and utility of your assets because Ledger has Ledger Live, which is a software. It syncs right up to your Ledger hardware wallet, and you can do anything that you'd want to do with your crypto assets. You can easily send and receive, you can buy and exchange, and you can get access to staking. And they've actually started to aggregate some of the best DeFi apps and services out there. Two of my favorites, Paraswap, a decentralized aggregator, and they've got Lido for staking. And stay tuned, I'm going to keep you guys updated. They've got some really cool services coming out soon. Aave, Compound, and 1inch among them. So if you take one thing away from this, guys, please, please, please make sure that you're protected in this space. Get yourself a Ledger hardware wallet today and start using the Ledger Live app. Click the link at the bottom of this episode. Thank me later. I'm not sure if folks will be familiar with John Pfeffer. He wrote An Institutional Investor's Take on Bitcoin. He came on one of our very early shows, and he described this as a venture investment in a new store of value, which I thought was a pretty apt framework for looking at the entire space. Be curious to get your thoughts on, you've got a couple of different frameworks for this, which is you've got kind of Bitcoin and gold are going to have, each are going to have kind of their own, they'll be able to coexist relatively easily. You've also kind of got this idea that Bitcoin might eat a lot more of the market share of store of value than existing stores of value. So that could be gold, but it could also eat market share into like commercial real estate or like the yen or like a whole bunch of different other types of assets. So I guess when you're looking forward at gold or at Bitcoin as a relative, what its relative market share of the store value use case looks like going forward, how do you see that, I guess, compared to other different buckets that currently occupy it?
Gold, the value of all the above ground gold is about 10, 11 trillion. Bitcoin is about 1 trillion or so, give or take. For me, it's the point that Lyn made, right? It's where can investors get real returns, inflation adjusted returns. So if that's available in the real estate market, then I don't see Bitcoin eating the real estate market, right? But if it's not available in bonds, then I can see Bitcoin eating the bond market. And if gold, if it's hard to get a yield out of gold, which we know it is, and it sits there and it's bulky and it's hard to manage, then I can see it eating gold as well. I don't see it eating equities because equities, I think, the compounding math is pretty undisputed. But I know, Lyn, if you have another take on that. But to me, it's like that 80s comparison of gold versus bonds. Once investors get a real return and can protect their value, I think that becomes a viable asset class.
Yeah, I think I have a couple caveats or a couple kind of thought points that I use when addressing this question. And so the first is basically, the whole Lindy effect, right? So the longer it goes, the more credible the next prediction becomes, right? So, Bitcoin at 60,000 was some people would dismiss that, 2 years ago, but here we are, right? So then when you're at 60,000, 200,000 sounds less crazy than when you were at 4,000, right? So as it kind of takes market share, and then you can assess the information at the time, and then you constantly update your model for how big Bitcoin could become. And so I generally start with conservative, kind of total addressable market, but then as it meets certain frameworks, it becomes easier to expand your base case for how big it could get, and as long as you start with the idea that actually you can have some upper bounds for how big it can get. And so that's the approach I've been doing. And then two, I would point out that, I think one of the problems especially the past 10 years, kind of the post GFC environment, a little over 10 years, is that, for lack of good money, people are clearly monetizing other things, right? So in the US, we have the highest equity valuations as a percentage of household assets we've ever had. And it goes back to the whole, there is no alternative, TINA, right? So
No.
they're like, well, I can't hold cash and bonds, and so I got to buy equities, even though I'm looking at, say, the CAPE ratio or the market cap to GDP ratio or whatever your preferred valuation metric is, and you're saying, well, I know they're expensive, but I have to hold them anyway. And so in many cases, we've essentially monetized the S&P 500 as a store of value rather than thinking of it as an investment. It's like we got to just shove money in there that we don't know what else to do with because we can't just leave it in T-bills. And so the same thing's true for prime real estate. So if you're a billionaire and you're trying to figure out how to preserve your wealth, you're like, well, I mean, I don't know how to value this beachfront property. It seems expensive. It doubled over the past 2 years, but I'd still rather own this than T-bills. And so the argument among some of the really bullish Bitcoiners is that if you do continue to reach certain thresholds and Bitcoin just keeps going, um, it becomes, if you have this kind of global hard money, it becomes an alternative that people have monetized these other assets. They've essentially added a monetary premium that is above their utility value. And so we're, in that world, let's say Bitcoin gets big enough, it becomes worth, tens of trillions of dollars, which is still small compared to, say, global money supply or global asset value. But if it starts to reach those types of market caps, you could argue that things like certain types of real estate, certain types of stocks, fine art, that things that people have put an additional monetary premium in for lack of good money might
Mm.
get drawn out and into Bitcoin, and that those things return to a more healthy valuation where they're mostly held for their utility value, and that they have more reasonable valuations. Therefore, they have higher returns for taking on risk, whereas Bitcoin becomes like the conservative gold-like hard money asset. But that's, of course, right now we're still at roughly a trillion market cap, so we're still kind of premature to that type of assessment. But that would be the argument for people that have a very optimistic look into Bitcoin's maybe 20-year future.
Yeah, and that's a great point because what you're really describing is the equity risk premium, right? I mean, at least for the stock market. So when investors don't have alternatives, they are willing to accept lower future returns, which is manifested by a lower ERP. And when they have an uncertain future, like in 1949, the ERP was like 15%, they really needed to get paid to take that risk. So I think what you're describing is really lowered ERPs across the spectrum because something needs to be monetized, and bonds and cash is a hard place to do it right now.
So in the same way that it's like software is eating the world, Bitcoin might eat the monetary premium of the world. It's not as catchy, I'll admit. Mark's got marketing on me, but that's a really interesting idea. Okay, let me ask you this then in that scenario, because here's something that I've always I'm curious about. So Bitcoin's CAGR over its lifetime, and you'd have to imagine that it would smooth it out, but something like 200% per year, right? Let's say that's your hurdle rate for investment. Let's say Bitcoin's CAGR gets cut by 75% and its CAGR over like the next 10 years is 50%. That's a really high hurdle rate for investing in capital allocation. On the one hand, that does sound very good, right? We probably could extract some speculation out of markets today. But on the other hand, I think if you looked at it from a slightly different frame of mind, you could actually say, man, that actually, I'm not sure that's so positive of a thing, right? Because there might actually be, the same way that there's been probably ridiculous valuation and overinvestment to the point where we're getting zombie companies, there could be underinvestment if the hurdle rate for your money was that high. What do you think about that counterpoint?
But I think you have to look at it as a Sharpe ratio, right? So the CAGR over the past 12 years is, I think, like 260%. And the vol is 200%. So the Sharpe ratio, the CAGR divided by the vol, is 1.25, which sounds crazy, but that's the same as a 60/40. Like a 60/40 index has a 1.25 Sharpe ratio, which is exactly the same as Bitcoin, but obviously the numerator and the denominator are orders of magnitude apart. So I think, from my perspective as a traditional investor, if the forward returns were to go down, which I think is highly likely as any asset class matures, you would want the volatility to go down with it, which presumably would also happen, right? I mean, we see even this year, the drawdown was 55%. A few years ago, the drawdown was 90%, right? So I think the risk reward characteristics as the asset class matures and evolves both the numerator and denominator go down. And I think that's how certainly institutional investors I think would look at it.
I view it similarly. That basically the earlier is early, basically you get higher returns in exchange for higher volatility and higher tail risk of the whole thing not working out. I mean, it had to go through these big tests. It had the Mt. Gox thing. It had the block size war. It's had these challenges. It had, half of its mining just move, within 1 year across the world. It has these crazy things happen to it. And so the more tests it goes through, the bigger it gets, and then the lower volatility it gets, the more widely held it is, the more normalized it is to hold a higher percentage of your assets in it. So there's that. And if you step back and kind of look at this process of demonetization of other assets, if that plays out, or at least in some direction, if it directionally plays out to some degree, I think it would have some pros and cons. I mean, any transition like that is going to be challenging. But the argument, for example, like Mike, I know that you've mentioned before, like the house price to income ratio, right? So we've monetized houses for lack of other things to monetize. As interest rates came down, is basically has been easier to justify those high prices, and that's really good for people that have owned a house the whole time. But it's harder for new entrants into the housing market. It makes it unaffordable for Gen Z and millennials in some cases to buy a home, and if they do, they have to go in a ton of debt to do it. Like my father was like he was pretty old when I was born, and so he bought his first house back in like the late 50s, and it was on like a police officer's salary. He just bought it when he was like 22. And it was a different time back then. You just buy a house on a middle income salary, and so say the argument from some Bitcoiners that would view as a good thing that the monetary premium sucked out of these things is that things that should be more affordable for the utility value would return to that in a more kind of sound money environment, let's say. Whereas you'd still have investments in things that are providing long-term value. But of course, during a transition, if you suck monetary premium out of a house, you could also suck a monetary premium out of something that is enabling new technology, new productivity. And so any transition like that is going to be a challenge. But I think if that hypothetical scenario were to play out, I think it would come with pros and cons. But I think as the dust settles, that should be a healthier environment because if you go back in history, people should be able to essentially save money in something that's not speculative in order to, build a retirement. And so they shouldn't have to have like 100% of their net worth in equities. They should have something that they can save in that's somewhat reliable. And right now, there's just not a lot of good alternatives for that, including Bitcoin at this current size, because for a lot of people it's too volatile. But in a world where, there is some sort of a, something that's acknowledged as money that's pretty stable, that gives that people can have a larger share of the net worth in it and then be more selective with the types of investments that they do.
After 3.5 decades in the business, I've come to the conclusion that the less drama, the better when it comes to investing, long-term investing. I don't want the drama. Quiet markets, good. I like quiet markets.
Yeah, I think it's good for people to basically address their own risk tolerance and specifically volatility tolerance. And so, someone who's put 1,000 hours of research into Bitcoin obviously can handle generally a larger position than someone who's just trying it out and just kind of learned about it last week. So there's that kind of if you were to chart like knowledge and conviction versus allocation, there's going to be a change there. And going back to the whole thing, if we say, okay, if Bitcoin's going to have a very high, say, double-digit CAGR over the next decade, some people ask, why not just put everything into it? I've had people ask me that question, and I said ultimately it's because of tail risks and it's because of human nature and volatility. And so I have a large allocation into Bitcoin, partially because I put a decent chunk into it, and also because it appreciated, fortunately, and it just didn't rebalance it, right? So it's a large chunk, but it's still small enough that when this summer, for example, Bitcoin more than got cut in half, I was like, it's not like so when people put their entire net worth into something like that, that's where they lose sleep, right? So people I think there's a range of allocations that make sense, but it comes down to their individual temperament, comes down to their knowledge on it, their conviction on it, and what kind of lifestyle they have, what their obligations are, as we go forward.
I want to ask just a final question, like actually moving forward on just the regime that you think we're entering, and a couple of different narratives that I've just consistently heard about inflation, and I just genuinely am not sure how to think about it. So one narrative that you hear about inflation, I've heard Luke mention this before, Luke Groman, is that actually, inflation has this kind of it tends to narrow the gap of inequality, so to speak, right? Salaries kind of get inflated, financial assets tend to get hit. It's not a super pleasant process all the time, but you might end up with a lot of the inequality that gets built up over a period of time getting erased. And then there's this other idea where it's like, ooh, actually, inflation tends to be, that's the malfunctioning of an economy. It is not a fun period of time to live through. It's a bad thing that should be avoided at all costs. What do you both think of those two different narratives? Do you subscribe to one more than the other? Is it something in between? I mean, what do you think about all that?
I'll just start. To me, it's the pendulum swing between capital and labor, right? I mean, we and the 1930s into the 40s, kind of a similar analog in time. So the last couple of decades was all about rewarding capital, owners of capital, and I don't want to say at the expense of labor, but labor certainly got the short end of the stick. And now, in the pandemic era, we see kind of the backlash, right? So now all of a sudden supply chains are broken and there's not enough truck drivers because nobody told their kids over the past 30 years, you should become a truck driver or a plumber. And so they all went to Wall Street or whatever. And now they're all going into crypto. But it's... So it's that pendulum swing, right? And so the capital and share buybacks are part of that. And I think mostly buybacks are benign, right? They're just companies like the FANGs generating more cash flow than they need. And so rather than issuing a dividend, they return it to shareholders indirectly via buybacks. But even like the current fiscal plans have a 1% tax on buybacks proposed, and so maybe that's another way that the pendulum might swing towards the labor side, the wages side, and in that sense, that would be presumably inflationary, right? Because that's going to create a wage inflation, and that would be an equalizer because then the pendulum is swinging. But I would imagine that, and then you tell me if you agree that if you run that to an extreme, and you have a loss of purchasing power, and you have a loss of margins on the corporate balance sheets, and therefore or income statements, and therefore companies are not investing or what have you. You can quickly get into a malaise where essentially everybody loses. So I do think that it's probably a fairly delicate balance. But I think that pendulum is just swinging from one extreme, the capital side, to the other. So we probably have a fair amount of runway before we get there.
I agree, and I've written about that general theme of that capital and labor, this long-term, multi-decade pendulum swings. And going back to the topic of inflation, the problem is that it's a very complex answer.
Right.
And what a lot of people do is they pick a subset and a narrative and they kind of just focus on that. Whereas it's one of those things where the answer to that question is inflation, how does it affect wealth concentration, is actually kind of, it's you need like a multiple paragraph answer to answer that question. And so just take a step back. Hyperinflation is like always bad, right? So when a currency breaks, almost 99% of the people have trouble. Businesses can't function when there's no pricing mechanism, and it's just bad for everyone. And even these like things that aren't technically hyperinflations, but just like horrible inflations that you see throughout emerging markets, where savings just get erased every generation or so, or cut in half. Those are terrible, and people should have a way to defend against that. That's, like the work of Alex Gladstein, from the Human Rights Foundation talks about Bitcoin usage in emerging markets, how a lot of these people, they just don't, they don't have access to stocks. They're stuck in their local currency and their currency gets devalued and they just have to start all over. Whereas, something like Bitcoin is a tool that they have now that basically kind of gives them back some of that power. So there's that, set of scenarios. If we look back and say United States history, if you look at the 1940s, the 1970s, inflationary decades, you actually had a partial reduction in wealth concentration during those decades, as measured by, say, the share of wealth owned by the top 0.1% or the top 1%, however you want to define it. You had a contraction in wealth concentration, and those partially related to the policies that were happening. So in the 70s, you had very strong wage growth. And you had equities perform very poorly. So the wealthy generally their assets didn't do great, while workers had their wages go up. It was a very unionized environment, very kind of pro-labor still, kind of the tail end of that. And then you also, if a middle class person had a home with a fixed rate mortgage, uh, that did very well financially. In the 40s, again, you had an inflationary environment. Obviously, war is obviously terrible for a lot of people. But kind of the during and the aftermath of it, there were some of these partially redistributive policies. So if you go before then to World War One, when soldiers came back, they just kind of gave them a bus ticket and they were like, "Thanks, we appreciate it." Whereas because you had this rise of communism in certain countries, and there were a lot of people sympathetic to it. They said we have to handle this better when soldiers come back, and so they did the GI Bill. They put them through college, they put them through technical schools, they helped them get homes, and they tax the wealthy at pretty high levels, while also, as we mentioned, inflating away their bonds, which were in large part held by the wealthy. And so you had that partially redistributed policy without going into like communism, right? So they said in order to not have communism, let's go like 20% of the way there and try to fix some of these imbalances, right? So that's kind of what they did. They kind of threaded that needle. Um, and so another way of looking at it is that when you have inflation, it benefits debtors over creditors. And so people often use the narrative that the problem is that the wealthy, they have all these inflation indexed assets, they have these hard assets, so they don't mind inflation, but that the poor and the middle class, they have most of their assets in cash, and that gets inflated away. But that's actually only partially, that's missing a big picture, because if you look at the data of the bottom 50%, and then you look at the next like 40%, the middle 50 to the 90, then you look at the next 9% and you look at the 1%. If you segment those four groups, as you go down the income spectrum, they have higher debt to asset ratios. So the bottom 50% have almost zero net worth because, they have roughly as much liabilities as assets. Then when you go up to the next group, the kind of the middle to upper middle class, they have more assets than liabilities, but still quite a bit of liabilities. They generally have a very large, say, fixed rate mortgage. They might have credit card debt. And as you go up, into the top 1%, they're actually very unlevered on average, unless they happen to be like a real estate mogul or something. Their entire net worth in real estate, they're highly leveraged. But other than like, specific examples, they are generally very unlevered. And so when you have that inflation, those say people in those lower middle spectrums, sure, their cash balances don't do well, but their mortgage gets partially, inflated away. Their credit card debt gets partially inflated away. Different liabilities like that. And so it's actually, and also they generally benefit from those redistributive policies. Whether it's the GI Bill or child tax credits and stimulus checks. It really depends on the specific environment. In this particular environment, so say the past 10 years, we've had, say, asset price inflation, we've had suppressed wages, we've outsourced labor, we've automated labor. And so this has been a wonderful environment for the top 1%, top 5%, top 10%. And it's been wealth concentration. And then even in here in 2020, 2021, when we did some of those, types of inflationary policies, we gave people stimulus checks, things like that. But if you look at the percentage of the money that went to that versus the entire spending, it's still actually a pretty small percentage, and a lot of it just flowed into corporations and asset prices still. And so that was one of those environments where kind of the top 1% did fantastic still. So it really kind of comes down to the nuances of how policy is constructed. And that's why it's one of those things. It doesn't make us a quick soundbite, right? So that's a really boring, long answer for is inflation good or bad for wealth concentration. I think that the ideal environment is you just have good policy and you don't have inflation and people have access to ways to protect their capital, like Bitcoin and whatever else. But when we in the kind of the current monetary structure we live in, it's just a really complicated answer to that question.
Yeah, and just one additional anecdote. Taxes obviously feature very, very highly in that.
Yeah.
During the 1930s, the second half of the 30s, tax rates went way up to the 70s and 80s percentage points, but the income threshold was very high. It was like 5 million in that time's dollars back in the 30s, and then in the early 40s when the U.S. went into World War II, the rate went up to like 90% or something like that. But the income threshold went from 5 million to 200,000. So that was a massive kind of widening of the tax pool that brought in a lot more revenue. So I do think taxes are very much part of that dynamic.
Yeah. And just almost, coming full circle to where we opened here, I love, Lyn, your kind of master framework of these 80-year cycles. The term unprecedented gets thrown around a lot today. Certainly, these are not precedented times, but they're not as unprecedented, I think, as other folks would have you believe. And if you go back and look throughout history, Ray Dalio, there's a book right there, Big Debt Crises, and I would say we're on the more extreme end of that right now. But many, there are other examples throughout history of when we've made it through periods like this and done very well. And Lyn, are you big debt of gratitude? I listened to some interview you gave years ago talking about the lessons of history, Ariel and Will Durant. There's a chapter in there on economics. I apologize. I gave you credit the first 3 times I referred to it. Then it was too long and I started passing it off as my own. But there's a great passage in there, describing 600 BC Athens and this wealth redistribution that they went through. I mean, it kind of just gives you chills to read about. So I highly recommend you go check it out. It makes me feel better to know that civilization has made it through even weirder times.
Yeah, and by the way, one nuance to the debt cycle is that everyone is in that cycle today, right? Usually it's one country running amok and then the currency changes hands in terms of the reserve status. But the U.S., Europe, China, Japan, we're all in the same boat. And that's why I think probably Lyn might agree with me that I'm not one of those people that thinks the dollar is going away as the reserve currency, because there's a lot of other dirtier shirts out there than the U.S. So I do think that's one important distinction, which doesn't hurt Bitcoin, because that can be a hedge against all devaluating currencies. But
yeah, my overall approach is basically that I see that global reserves are diversifying more. And so we have kind of Russia and China interested in de-dollarizing to some extent. And so my framework is essentially that the dollar is shifting from, the global reserve currency, meaning the only currency you can buy oil in, to, a reserve currency, perhaps still the biggest, and just kind of a lower percentage of that basket. And then, there's some areas where the U.S. is the cleanest dirty shirt, so it's got some of the best geography. They say the central bank balance sheet is still a smaller percentage of GDP, than say the ECB or Japan. And whereas the areas that we're the dirtiest dirty sheet in generally relate to our wealth concentration, our structural trade deficit, and military industrial complex spending, those sort of deficit spending, healthcare costs as a percentage of GDP or per capita compared to outcomes. So we have a lot of kind of those specific issues. But yeah, in terms of the long-term debt cycle, many of these countries are in similar circumstances, especially at least among the developed world as a whole.
Yeah, absolutely. Well, you both have been already very, very generous with your time. If folks want to find out more about you, Lyn, or you, Jurrien, what are the best resources? Follow you on Twitter, subscribe to newsletters. What's the best way to do it?
So I'm at lynalden.com. I have a free newsletter, and I'm on Twitter at lynaldencontact.
I'm on LinkedIn and on Twitter as @TimmerFidelity.
Excellent. Well, thank you both. This has been, in case you haven't told from the smile that hasn't left my face this entire time, this has been a ton of fun. I've learned a lot, and we'll have to do it again soon. So thanks so much for coming on.
Thank you.
Thanks.